Hi, and welcome to PSA People, Stories, and Accounting. And today we have a very, very special episode. I am here with Nadav Ellinson and Shaked Persi. Nadav coming from Blue and White Financial, and Shaked coming from BDSK on Israeli taxes. Nadav, you want to share something about yourself quickly? A 30-second pitch?
Sure. So I'm a financial planner and I work with young professionals in Israel. And I'm very excited to look at some of the financial planning aspects of the Trump accounts. It's a pleasure to be here with both of you.
And Shaked?
Yeah, hey, great to be here. Thank you very much, Jacob. I'm an Israeli CPA. I work with a lot of Olim Chadashim, new residents, and just American citizens that live in Israel in general. And I'll be happy to share my thoughts about the new Trump account.
Yeah, and I'm very, very excited to discuss this with you guys. I was just thinking earlier that there is about like any number of topics that we could go over that would just be phenomenal to talk with the both of you involved. Today, we are going to zoom in on the Trump kid accounts that they are just starting out. The IRS released some new information about it, the main structure of how it will work and everything. There's more guidance that will come out in the future, and they haven't started just yet. But with everything that we have, I wanted to kind of go over it, introduce the topic to people, specifically US citizens that are either moving to Israel or are living in Israel, how it will apply to all of them, how it will affect them. And so I wanted to kind of get your unique aspects, both from the financial side, from the Israeli side. I'll cover the US tax side, and we can really kind of dive in and see what's going on. To start off, maybe I will start with kind of what is the basic guidelines and the main core functions of this Trump account, which is just very, very interesting, which is it is a new account for kids, for children. They can be any age up to 18, open this account. Okay. It is totally handled by the Treasury Department, which is interesting. It is not something where you are going to a financial investment broker and saying, hey, open this type of account for me. It's something that will be managed by the Treasury. The Treasury will speak to those people and open it up, and then you will have one. But it is something that has to be involved with the Treasury, the US Treasury. And so what is interesting is that they wanted to put in together something that helps kids at a young age that will then be able to grow and be there for them when they get older, all the way until retirement, technically. And so it's very interesting. And the way that it works is you will be able to elect to open up one of these accounts for any of your kids. Again, any kid up until the age of 18, there is a growth period of what happens during those first 18 years and what are the limitations from it. And then there's stage 2 of it, kind of what happens after that. And so if you have any kid that is 18 or younger and you open up one of these accounts, the main thing is you can put up to $5,000 per year into an account for one of these kids. And Nadav is going to go through, what that actually means long-term for people and how that can help. And for US purposes, anyone can contribute into this. So in Israel, we used to have, I know we're going to compare this to the Chisachon L'Kol Yeled, but Shaked, I remember that when I started working in the US tax sphere, every single person that grew up in Israel, their grandparents opened up a Kupat Gemel Hashga'a for them when they were like 2, 3 years old, and it would just grow and grow and grow for them. And that was always a PFIC issue for the US citizens. But it was something that like people were able to just put money away and it would help them.
And completely tax-free for, at least from the Israeli perspective.
Exactly. And it was like a phenomenal tool, right? So this is going to be something like that. The idea was, let's put money away. It will be tax-free as it grows. They'll have it for a long time. And then eventually, when they retire, they'll be able to take this money out, right? And so there is that limit. Anyone can put money into it for any kid, but there is a limit of $5,000 per child that can go into it. So if the grandparents are putting money in, if the parents are going in, putting money in, a neighbor who decides to give money to your kids for some reason and put it into one of these accounts, everything is maxed at $5,000 per kid for everyone together. There's also a way that, I don't think it will apply really to our clients, but there are ways that employers can put money into these accounts for their employees' dependents. But again, it's up to $2,500 and it goes against this $5,000 total limit. The one extra benefit of this is any kids who are born between 2028, they will get from the US government an additional $1,000 put into it when it opens. So if the child is 2025 through 2028, they're born in that time zone, then they can get an extra $1,000 that can be put in. So that is a big help and addition. And then the last thing I would say to just kind of cover the basic ideas of it is there is a whole philanthropy angle, the biggest one currently being Dell, Michael Dell, who is the CEO and owner of Dell Computers. Really, he has donated $6.25 billion, I believe it is, for people. And
Wow.
it's very funny to look at what he said and then looking at the codes and understanding how it actually works. But he basically put money into it for a specific group set of people to also be able to have additional amounts. And so
Mhm.
that is something that we can dive into a little bit more to understand because it could be particularly cool for people. So yeah, so
Okay.
that is the basic idea of it.
And Yaakov,
Just
do
a
you know?
question, Yaakov. So the 5,000, is it like a collective sum? It's like if I put for my kid $2,000, it means that my mother could put another 5,000, or she can contribute just 3,000, what's
Yeah.
left of the five.
So it looks like currently the way that it works is that it is a 5,000 cap for everybody. So if you put in 2,000, your mother can only put in an additional 3,000 towards it. But it is for each kid. So now we can start picking favorites, you know,
Nice.
which one. So yeah. But it's 5,000 capped. Also, if you get money from your employer, it's 2,500 for all of the dependents, which was actually kind of something that was interesting. I think people thought it was 2,500 for each dependent that you have. The employer can only put in 2,500 for all of your dependents, and that will also go against the 5,000 total that you're able to put in per year for these accounts.
And it will not be taxed like
And
as a
it is
salary.
so yeah, so it's actually gets really funny, and it is something where the financial advisors who are the financial holders of the account the trustee basically has to keep track of it very carefully
Right.
because it depends on who is putting money in. If let's say I put money in for my child, so the money that I put in for my child has a basis already in there. But
Right.
let's say that my employer puts money into it because for me, it's post tax money that I'm putting into this account. But if my employer puts money into there, so it is pre tax money that they're putting in, it doesn't get taxed. And then that amount that they put in does not have a basis. So let's say I put in 2,500, my employer puts in 2,500, and then in the future, I take the money, my child takes the money out. It will basically have whatever the growth was minus 2,500 because it takes into account that mine was post tax,
Only your
but
basis.
not the employer.
They've got to make it complicated.
Yeah. So it gets complicated. Similarly, if the philanthropists, if the people are putting money in, that the nonprofits are putting money in for these kids, that also does not add to its basis. So it makes it complicated. It means that trustees have to track it very carefully until the age of 18, and then at that point in time, it kind of goes to again this phase 2 aspect of it. But yeah.
Well, interesting. What
Yeah.
about the $1,000? Is it included in the cap? The
So
seed.
no, so that is totally separate. So that is where it gets interesting. So again, the 5,000 is based on any kind of contributions from family members, people, and work. That philanthropy side, so like the Michael Dell side of it, totally does not connect to that 5,000 cap. That 1,000 from the government also does not add to that 1,000 cap. There's no connection between those two. And in theory, what's crazy about the Michael Dell thing is the way that it works is philanthropists can put in specifically, it can be zone based, right? Like zip code based, or it can be age based, but it can't be anything further than that. So, for example, it could be like anyone who was born from 2020, 10 and onwards, which is what he did. He basically said, and you'll see the way that he does it is very interesting because he wants to give it to lower income houses, but you can't say, I'm giving it to anybody whose family doesn't make $150,000 or more, you know? So what he had to do was he had to say it's anyone who is the age of like from 2015 and onwards, so that this way they're not the people who fall into the 2025 category, right? That don't get the $1,000 from the government. He specifically wanted it to the people who don't get that. So he did an age group for the people who won't get that. So if they're born in 2024, I guess it would be somewhere like 2015 to 2024. So this way they're still under 18, by the time they get to 2028 potentially, but also in zip codes where the median income or the average income, and it was confusing how he worded it. I don't think anyone really knows yet in terms of how it actually will work with what he's giving, uh, is less than 150,000. So he did it based off the zip code where the total income of the area on average or the median of it is actually lower. What that leaves open though, which was interesting to me, is that theoretically people can say all kids between this age group in Israel should be able to get this. And then it would specifically apply to US citizen kids who are in Israel, which would be very, very cool and
And so
interesting
we
to
can be
see how that
considered
would
a
go.
zip code for the purposes of the location-based distributions.
Yeah. So you could do it based off of location. So yeah, so that leaves that door open.
And to clarify which children are eligible, is it anybody born between 2025 and 2028 or any children that are under 18 during those years?
So it's any children under 18 can open an account. And it's not only during those years. It's any children under the age of 18 can open an account.
I mean,
But
for the
it
$1,000 Trump.
but the $1,000 is specifically for kids born between 2025 and 2028. And they also have to be, this is the other tricky part of it, right? All of the kids who you are applying for this for all have to be US citizens with social security numbers. And as we know, to get a social security number for kids born in Israel, not the easiest thing in the world, right? You have to schedule an appointment at the embassy and it's a pain in the neck. You have to wait for that appointment and get it. You could technically fly to the US and do it there, but it's not the easiest thing to get them social security numbers.
Cool.
Now you have a nice incentive to do it.
Yeah, if the child tax credit refunds weren't enough, now here's another way,
It's more money.
another thing that to kind of
So
push
tell
you.
us a bit more about the transition. You were talking about stage 1 into stage 2 in order to understand, does it make sense to put money into this account?
Yeah, cool. So stage 2 is basically you can, once the child turns 18 on their 18th birthday, right? It's not like usually we have with other IRA rules. It's when you turn 59 and a half or the year that you turn, it's within those years. This is specifically on their 18th birthday, basically. The child can leave it in that Trump account if they want to, or the custodians of that child can leave it in that Trump account, or you can convert it into a traditional IRA. Okay. And that's important mainly because of how this thing is going to be treated. These Trump accounts cannot have it is like a lock, right? You are putting it in there. It is, Nadav, you can get into the difference of like funds and how you get money out of them and what the benefit is and everything else. This is like a locked box. You are putting this money into it when it's in a Trump account and you are not able to get it out whatsoever. There are very few cases where you are able to, but it's mainly like if, God forbid, something happens to the child and they pass away. Other than that, like it is stuck in there. You can't really get it out. There's no excuses for why you'd be able to pull it out until they're the age of 18. Once they turn 18 and onwards, you're able to take it, move it into a traditional IRA, right? In which case, then it is still there. It is still going to be investing and earning money tax free as it grows for US purposes. And you're able to, the investments open up more broadly in terms of what you can invest in. And then you have all of those special IRA exceptions, like let's say tuition and the like, that you might be able to pull the money out. First time home buyers, you're able to take up $10,000. It is a taxable distribution at that point in time, but it does open up more in terms of what can and what can't get out. So phase 2 is really kind of more broad IRA. There are some things that will carry over with it, like the fact that it's a Trump account. It'll have like the name of Trump account with it still,
Okay.
but it won't be still in that IRA. That's the
And
general
so
idea of phase 2.
for all practical purposes, it's treated for US tax purposes as an IRA from then on.
Exactly. Even from the very beginning, the way that these laws are written is they're written in the same format like IRAs. They are considered IRAs for US tax purposes in every way with more strict limitations while they're in that 18-year phase. Then after the first 18 years, it moves into a regular IRA.
Yeah, that's interesting. I mean, they built something upon like a tool that already existed, and they just made it, better. It's, I guess, the younger generations, they don't like to save for the future, or they probably don't believe, in long-term savings, and it kind of make them because of the strict limitations.
Right. Yeah, absolutely. It's funny. I don't think if you stop a kid on the street and you ask them how much money they have putting away, There isn't much. There isn't much. And there is now there, you can compare this. That you could put into for a child, you could start an IRA for them, but that gets into a whole gimmick that people use of like, oh, my child who's 10 years old is working for me. And they're making, $7,000. And therefore, when they make that $7,000, I put it into an IRA for them. It feels very gimmicky. It feels very funny. Like, is your child actually working for you or not? And so this way, it just makes it easier. You want to put $5,000 away for your child. Here's an easy way to do it that will invest in their future,
Yeah.
that they can then get the money out when they retire. And you can rest assured that they will have this.
So if we're thinking about the different US tax advantaged accounts, because there's a number of them, why would somebody prefer this over some of the existing options?
Right. So again, there's that IRA, which is again limited to if the child is working or not. And so this is like very clearly, your younger children, 1 to 9, I would say like you have no way of claiming that they're working. 10 and older, it's a question, are they really working or not? Right. But in theory, this still allows you to put that money away into it. Right. It lays the groundwork for you that you could do it. Other benefits that they have in the US generally are like 529 plans, HSA plans are more focused on a specific thing like tuition or healthcare and the like. And so if you think about, for example, our generation, I grew up in America, we had to pay for Hebrew private school, which was expensive. Now it's like beyond expensive. 529 plans are a huge help there. But for the Israeli day schools and the like university, 529 plans that you put money away to doesn't really, you're not really going to use it for educational purposes the same way. You don't really need it. So this is just another way of putting money away for kids in a way that you can, rest assured that this will help them future later on in life that isn't necessarily have to be for educational purposes.
So if the ongoing growth of the account will not be taxed, so when are they going to be taxed?
Right. So the idea is in theory, the idea of this is that you leave the money in there and then it's something for them for pensionable age, right? It turns into a standard IRA. And so at, call it 59 and a half, 60 years old, 62 years old, when they retire, they will have this money to kind of pull out. And Nadav, I know you're going to get into it a little bit later potentially, but I mean, just as a quick snapshot, I mean, I'm assuming if I'm putting $5,000 away now, even one time, that's going to turn into something that by the time that they're 60 is something meaningful for them to have in terms of retirement. Yeah.
Yep. With incredible growth of compounding.
So at that point in time, that's when you would have the US taxation on it. And again, how much basis do they have in it? I'm going to assume that the basis is almost nothing because again, it's like 2,500 if the employer is putting it in, and again, if we're looking at this 60 years from now, what is that 2,500 going to be in comparison to the whole amount, right? The amount should be significantly higher and better. And so with that in mind, it should be something that when they take it out, you can assume that the vast majority of it will be taxed as ordinary income rates for US purposes, right? Now, I'm going to turn the tables on you for a second, and I'm going to ask you, okay, so now we know the US is going to tax this thing at 37% when they take it out potentially, or up to 37% marginal tax rates. What about Israel?
Okay, so from a US side, it sounds very promising. It sounds very good. The benefits are clear. And you brought me here to ruin with the Israeli tax implications. So here I am. But actually, it's less scary than people might think. I mean, Israel, usually it can see things differently than the US, but this time it might make sense. It's not something that they're unfamiliar with. So, the Israeli tax authority, they understand case, they know about IRAs, Roth accounts, so it's not like something, unknown for them. But an important note will be that they never published an official position on IRAs or Roth IRAs. So it's always a question on how they're going to treat these accounts, the withdrawals from these accounts. There's nothing certain that I can say, but we have a lot of experience and how we analyze the law and the type of these accounts. We can say that the most reasonable thing will be to treat it as pension. And now I'm talking about an IRA account. Okay, I'm not talking still about the Trump account. So everything that I'm going to say, it's from the practice. It's what we're doing when we're dealing with the tax authorities, when IRAs come up, but there's nothing official that we can rely on at this point of time. I hope that, more types of accounts and retirement vehicles will be available. They will decide to finally publish something about it. So the way I see it, there are two ways, or 2 to 3 options that they can treat the Trump accounts. One of them, it will be a pension account. The second one is a regular investment account.
Okay.
The third one is something else that they will decide, but we can't know for sure. If it's a pension account, okay,
Yeah, I was
and
gonna
this
say,
is
what is
my bet.
I would right. I would assume that the second one is the worst case scenario there, if it's treated
Right,
as a regular
totally.
investment account.
Right, totally.
Okay.
So if it's a pension account, first of all, it will match the U.S. view and the U.S. Tax treatment, and the tax deferral will be there. So the ongoing growth will not be taxed, meaning that everything in the account, if it's dividends, capital gains, interest, it will not be seen by the Israeli tax authority as income, and it will be deferred to when you take it out of the account. When you take it out of the account when you retire, which is also an issue because in Israel the retirement age is 67, and
Okay.
in the US it's 62. So you might
Right.
take it out in 62 in the US, and it will not be recognized as as something, as a certain benefit that you can get when you retire in Israel. But we'll
Mm.
get to
So that's
this part.
interesting. So meaning it could be considered a retirement account for US
Right.
purposes, but not for Israeli purposes specifically just because of the ages that they're taking it out in.
Right, right. Because we know that there are certain benefits that we'll talk about that
Yeah.
are that can be applied only when you reach retirement age. If you didn't reach retirement age, you will not get those benefits. And we know that for U.S. citizens that live in Israel, there are two tax systems that
Right.
take the taxes, and that might be, you can get benefit in one country and
Mm-hmm.
lose it all in the other one.
And you end up with the worst of both worlds.
Yeah, yeah. So the second option is that they're going to treat it as a regular account. And like you said, Jakob, that's the worst case scenario. Because first of all, it will be a huge mismatch with the US. Israel will want to tax the ongoing profits, and in the US, you will not be taxed. Then there's no tax credits. And when you take it out at retirement, it will be the opposite way, right? So in Israel, it will be tax free because it was already taxed. And in the US, you will be taxed. So that's probably the worst case scenario. And I think they will not go this way because they don't have any incentive to make such a accident between the
Right.
two laws. And, these accounts, it smells like pension. It walks like pension. It's probably something that should be taxed as a pension. So
Right.
my bet is that that's how they're going to look at this account.
Okay. And pensions for Israeli and US taxes are always kind of interesting because it always depends when where the person starts it, right? Where they end up being, and then when they take it out, right? So, for example, we always have these interesting cases where, let's say, someone has a pension account and they make aliyah, right? And special rules apply to them. Or if someone leaves the US, then or they leave Israel rather, and they move to the US, right? And that kind of takes them out of the Israeli tax system.
Right.
And then there's a whole issue with inheritance and the like that also comes up usually.
Yeah.
And do you see, like, let's say that they are treating this as a pension, right? Do you see a difference between, let's say, I live in the US, I want to fund this for my kids right now. I seem like it's a great idea for them while I'm in the States. And now all of a sudden I move to Israel 5 years later. And so now the kids grow up in Israel having had these accounts funded already. Is there a difference between that and someone who grew up in Israel and their parents put money into it from before they came?
Okay. So first of all, to understand the taxation of these accounts, I'll just mention that retirement accounts are and IRAs and probably the Trump accounts, they will probably be taxed when you take it out, when you withdraw the money at ordinary income rates, so at your marginal rate. And there is a huge benefit here, right? Like we say, and Nadav will explain later on, the growth will be very substantial, and we're expecting to have very minimal principal and a lot of growth in the account, a lot of interest. So the downside here is that you're going to pay ordinary rates when you take it out.
And in Israel, that's up to what?
It's up to 50%.
50.
Yeah.
Okay.
Yeah.
It's amazing.
The downside, the second downside, is that you're going to avoid any contributions. Okay, so it will all be taxed at regular rates. So it doesn't matter if you deposit, 100K over the years, your employer, you, everyone contributed together $100,000. It will be taxed when you take it out.
Okay.
So, yeah, so that's the downside.
Now I should add one small important nuance here, which is that let's say you're in Israel and you are paying this 50% tax in Israel, you might be scared, like, hold on a second, I'm going to pay Israel 50% and I'm going to pay the US 37%. Like, what is
13% in your pocket?
Right, exactly. It's like, I don't know how much money this thing is earning. Even if it earns millions and millions, you're ending up with peanuts. So no, there is this treaty in place, right? And so if this is treated like a pension, which for US tax purposes it absolutely is, it's treated like any other IRA. So then it should fall under treaty benefits, so that while it's taxed for both Israel and US purposes, if you are living and residing in Israel, Israel should get the first bite of taxation, and then the US will give you what's called a tax credit. So if all of your income is Israeli source income and you are paying 50% on this Trump account distribution at the age of 62, 67, whenever it is that you take the money out, then the US, you should effectively have zero US income tax because you will be paying Israel more than what you would have had in the US, and Israel gets the first right of taxation.
Right. So yeah, the treaty kicks in here.
Shaked, many people listening may have heard this concept that Israel generally won't tax you more on retirement savings than what the original country would have taxed you on. How might that apply to these accounts?
Right. So yeah, that's a good point, and it connects to Yaakov's question about the Olim Chadashim, the new residents. So I'll answer Yaakov first. You said that if I come to Israel and my kid is 5 years old, what happens then? Well, for Olim Chadashim, there is the famous 10-year exemption, and if your kid is 5 years old and they have the 10 years, they're probably 15 when the 10 years are done, so no withdrawals at this point. So the 10 years won't really matter here. Yeah, and they will be taxed only at retirement. So we're talking about 50, 60 years from the moment that you arrived to Israel.
Mm-hmm.
And I hope that you stayed all these years.
Amen.
Yeah, so about Nadav's question, that's right. There are two also famous, I guess, provisions that called Tesha Bet and Tesha Gimel, which are benefits that apply to foreign pensions. Now, Tesha Gimel, that's the more interesting one. It means that if you have a foreign pension and the funds in the account are connected to work that was performed outside of Israel, when you take this money out, you will not be taxed more than you would have been in the paying country, so in the original country. So, for example, if in the US you would have paid, I don't know, marginal rate of 20% or effective rate of 20%, Israel will not tax you more than that. So you will pay this tax to Israel. The US will give you the tax credit, like you said, Yaakov, and that's it. You will not pay more than that.
Which is really important for us here in Israel, where the tax rate is often a lot higher than paid overseas.
Yeah. Now, the bad news here is that the Trump accounts will probably not be able to use this benefit, because this benefit is, the condition is that the funds were deposited from your work, from someone's work that was performed outside of Israel. Now, these accounts are funded by third parties, parents, the government, and That's why it will most likely not be applied, Tesha Gimel, to these accounts.
So is it the fact that it comes from your work or the fact that it comes from work in general? So for example, like let's say I'm working in the US and my employer is putting $2,500 into my child's account, right? Now, is it important that that would be coming from work, right? But it's coming from my work, not necessarily my child's work. So does
Yeah.
that make a difference there?
So that's a creative way to look at, at this. And we know taxes are, you need to be creative. But here, if you go, like if you read the language of the law, it's pretty clear that it should be like the account's owner work. So if your parent contributed money from their work, you will not be able to use Tesha Gimel.
Yeah. Okay. And that is also just as an interesting side note with that caveat, it's also one of the reasons why people are always looking at IRA accounts as potentially phenomenal assets to leave to beneficiaries if you were to pass away. But specifically, if you and your beneficiaries both live in Israel, you might get that Tesha Gimel benefit if it comes from your work. But if you leave it for your kids, they won't necessarily get that benefit. And
Exactly.
so it's always something to keep in mind when you are looking at, your own retirement / estate plan that comes up. Okay. So Tesha Gimel is basically, we're saying potentially out the window with this, right? That's not going to apply. Tesha Bet,
Yeah.
how does Tesha Bet work? Is there a chance that could come into play?
Okay. So the way these provisions work is they give you the permission to choose the lowest, your best tax consequence. So if you can use Tesha Gimel and it gives you, like Tesha Bet gives you a better tax advantage, you can use Tesha Bet. So Tesha Gimel doesn't apply here. Then you
Right.
go to Tesha Bet. Tesha Bet, it's pretty simple, right? So it gives you 35 exemption on Israeli tax for certain pension type accounts, and it will only apply when you reach retirement. So once you reach retirement, you take out money from a pension account, and you will have 35% exemption on this withdrawal. So for example, you took out 100K, 35% of it, 35,000 are exempt from tax. You will be taxed at marginal rates only for 6,500,000.
Okay. So that's like an automatic savings. And do you think there's no wording there that it has to come from your employer and from work?
No. So Tesha Bet will apply for the entire thing. They will not split, the amounts between, different contributions that were made from employers, government, relatives. It will also apply if you take it out in one sum. So if you take it all out, I don't know if that's possible from a US perspective, but if you decide to take it all out, then you can still use the Tesha Bet benefit.
Okay. Interesting. So then if I'm just looking at how that computes overall, I'm thinking US and Israeli tax both at the same time, right? So let's just think for a second, if it's under Tesha Bet, so we're saying it's 50% tax, but it's 50% on 65% of the income, right? Where in the
Right.
US, you're looking at it being potentially up to 37%. Let's say you're in the highest tax brackets, you're a wealthy retiree, your parents put this money away for you. So you're in that 37% income bracket in the US. So then I'm just curious, it will probably depend on the amounts that we're talking about to see how it actually shakes out, if there'll be any
Yeah.
leftover US tax due or not.
Right. It might be kind of similar. Uh, yeah, if you take it into consideration.
Yeah. I mean, you're paying effectively on like 100,000, you're paying 32.5%. So it could mean
Oh,
that there might be some US taxes due afterwards. There's ways of offsetting that foreign tax credit buildup and the like that we will work for. But I will say, come back to us in about 60 years when you have one of these
right,
accounts and
right,
you
right.
None
retire.
of
We,
this will
we will not
apply.
be here. We
Not
will
again.
not be here, but
But yeah. Okay.
yeah.
That's very cool. Very interesting.
Yeah,
So we're looking at
Trump needs to get something. It's his account, right? So it makes sense. At least 5% he needs to
So
get
I will
from
say
this
this,
deal.
there's two things that I love about these accounts, just like in terms of how everything plays out. Okay, number one, Nadav, you're going to talk in a minute or two about the financial aspects of it and how it works and everything. one of the things is what you're allowed to invest in with these funds, right? In that phase one. And it is very limited, and it is basically US investments, right? And it's more limited than that. But one of the things I love about this is that it is a way that wealthy people can put money away for the benefit of US kids, that US kids can benefit in the fact that when they retire, they will have a livelihood. And at the same time, all of the money is reinvested into the US economy. Like, there's something very cool and very like planned out and neat from that perspective, that everyone benefits, right? It is a charitable contribution from these, big people who are giving money into it, going back into the US economy, going back into US citizens. The kids will get these funds eventually. And at the same time, the US economy benefits from having all of this money you know, invested into the market itself, the US market itself. So that is very cool. The second thing, which I think is my favorite thing about this, is the form number that comes out with opening and making an election to open one of these accounts. There's a form number on your tax return that you can file starting 2026. And there's a draft of it right now, and it is called Form 4547, right? And those numbers, anytime President Trump comes out with anything, like, for example, these accounts, it is called a Trump account, right? It has to have his name attached to it. It has to be there for the ego building, so that this way in 60 years from now, these kids will still have these Trump accounts and will still be like, oh, thank you, President Trump, for creating this. Form 4547 is specifically the presidencies that he's had. He is president number 45 and president number 47. And so that is
Wow.
where the numbers for the form came out. It is like perfect. So if anyone has
Long-term
any
thinking. Long-term
exact
thinking.
there's always games. If you have a part of the government that you open up and called, Doge, and then you have like this opening up
Yeah,
Trump accounts, and how Guilty originally started in 2017 and was called, the Guilty tax. It's just someone there has a lot of fun with the names and the form numbers, and kind of laying all of these Easter eggs into governmental things that you would never think, like, this is the last place I expect to find these Easter egg type projects. Yeah. Okay. So that is the Israeli side. Shaked, anything else you want to add to the Israeli side of it? Anything that you think we forgot about that we should bring up?
I think that, from Israeli tax perspective, it's pretty simple, even boring, which is good. It's good. There are a lot of adventures with Israeli taxes, and here it might be very beneficial for kids to get the benefits of this account. And as long as the tax authorities have not published an official opinion or position, yeah, that's where we are.
Yeah. And would you expect that there's some reason why they would give a position for these specialized accounts more than they would for regular IRAs or anything else?
Yeah, I think that, if something, then they will publish something about the IRAs and it will impact the Trump accounts.
Right.
But I can't see why they will, give special treatment to these accounts.
Okay. Interesting. Okay. And if someone leaves Israel while they're holding one of these accounts, then,
Well,
you know,
that's good because Israel see it on cash basis. So, you take it out when you're out of Israel. Israel has no no bite, like we say. There's
okay. So we're not giving anyone advice, and we certainly don't want to help people leave this country. But if they do, then eventually when they do take the money out, the idea is that Israel, unlike the US, more like every other country in the world, is a resident-based tax country. And so if you are no longer a resident, you wouldn't be paying tax to Israel on your non-Israeli income. So yeah. Okay.
definitely.
So Nadav, let's get into, is this, so everyone has now heard about US taxes, Israeli taxes. Overall you're looking at somewhere in the 30% range when you take these funds out, potentially at the highest. What is it going to look like from a investment point of view? Does it make sense? Does it not make sense? Are there better options out there?
Okay, cool. So, as you've both kind of pointed out, there's a lot of elegance behind the way that the accounts were built, and they can very much apply to Israeli residents, US citizens who are Israeli residents living here. And they certainly can be used. And I think that the first thing that is valuable to explore is just the impact of being able to put money aside for your children, for your grandchildren, for something like 60 years. And when it comes to long-term compounding, we really have to go way beyond what our intuition tells us about how numbers work. Because if, for example, you invest money in the stock market and you get a 10% return per year, the most simple math would come along and say 10% a year, let's multiply that by 60. And so we get essentially 6 times growth, which is pretty nice. So if you come along and put $10,000 into an account and it grows 6 times, suddenly you have $60,000 when you retire. But the nature of compounding is that it's so much more impactful than that. One of the stats that I often share with clients and share with our community is that if you invest for 30 years, then you'll get a 10 times return on your money at average kind of rates of return at the stock market. So invest $10,000 and you'll end with about $100,000. But once you start getting beyond that 30 years, the exponential growth is really incredible. When you're investing for 40 years, suddenly you've multiplied your money by 20 times. If you're investing for 50 years, you've multiplied your money, 50 years, you've multiplied your money by about 50 times. And 60 years, you multiply your money by about 100 times. And so if we go back to that example and you're investing $10,000, suddenly you're retiring. We haven't taken into account inflation yet. We can talk about that too. But in terms of nominal amounts in your account, you've got $1 million from that single or 2 years of contributions back 60 years ago. And so the fact that you've got the US government encouraging people to put money aside to be able to compound for the long term means that hopefully we're opening up the impact of long-term investment returns to much wider segments of the population, and being able to, in some way, perhaps distribute wealth
It
across
reminds
individuals.
There used to be that riddle. I don't remember exactly how it goes, but it was like, would you rather like $1 million now or like a penny that doubles every day for the next 60 days or something like that? And it
Right.
was like, if you took that penny option, you'd end up with like over $15 million. And no one would ever, by default claim that. They'd all be like, yeah, no, give me $1 million.
Yeah. And that's really the hard thing about long-term financial planning, because when you're experiencing it and you're beginning, it's very slow. Some years you're getting a few percent return, some years better, some years you're losing money. But if you're able to put something aside and have the discipline to not touch it, then that's when you can start seeing this incredible growth. And so the nature of the fact that the account is locked up and you can't essentially touch it, and the money is segmented away for retirement, means that there's that inbuilt level of discipline that will hopefully allow that money to grow. Many other caveats that I think we'll get into shortly, but as a concept, being able to invest for the long term for your children is really, really important.
Yeah, and part of me loves that because one of the big benefits that people in Israel here get, if you're a US citizen living in Israel with kids under the age of 18, the child tax credit refund kind of comes up, right? And so let's say I'm working in Israel, all of my income is coming from my Israeli salary, and I have 5 kids under the age of 18. The way that my tax return for US purposes could look if filed like this would be that I make X amount of money, right? I pay way more in Israel than I owe in the US. So I don't owe anything more in the US. And by the way, I have 5 kids under the age of 18. Give me $1,700 per child, please, as a refundable credit, right? And so I would get $1,700 per child in my bank account. And now I just feel like instead of taking that money, if that's not money I need to live off of, right? Being able to take that money and then be like, okay, well, let me just take that exact money and put it into account for my child. I don't have to put the full 5,000. I could put in that 1,700, 1,800 as it grows with inflation each year. Then all of a sudden, that money that you're putting in is now going back to your child and can kind of sit there and grow over time. And it kind of builds those habits that you're mentioning.
Yeah. And I think that's
Right.
a really incredible way to plan around those tax refunds, which are very predictable and which can form a very good basis for savings for kids. Now, I want to take a step back because although the account is exciting, whenever we're doing financial planning, we have to start by having a look at what our goals are, what we're looking to achieve when we're putting aside money for kids. And I work with hundreds of clients a year in their 20s, 30s, 40s who have young kids, who have teenage kids. And I am yet to have one client whose primary goal is to put money aside for their kids' retirement. And I think there are two reasons for that. The first one comes from the nature of the retirement system here in Israel. And I think maybe it's worth us spending a few minutes going through that because it really has a significant impact on how people living in Israel should plan for retirement and what kind of role Trump accounts can play within that mix. When we're employees in Israel, and we'll put self-employed individuals aside at least for a moment, when we're employees in Israel, there's an incredible amount of money that automatically goes into the Keren Pensia or the other retirement vehicles, into the Israeli retirement system. And that is an account which in many ways is very similar to an IRA, an American IRA, in that a lot of the money is deposited pre-tax. When you eventually pull it out later, when you get to retirement, there's tax to be paid upon the withdrawals. And the amount which is deposited in adds up on average to about 20% of your gross income. When you include the employee contribution, the employer contribution, and the third component called pitsuim, or which was once upon a time severance pay. And so someone earning 20,000 has 4,000 shekels being deposited every single month away for retirement.
So if you're making a large amount of money and you're wondering where all that money goes, it's either to the Israeli government for taxes or to the retirement plans.
Exactly.
Okay.
And when we ask ourselves, is that enough? Can I retire at a comfortable level? Can I maintain my level of lifestyle? Let's say at age 67, if I retire at regular retirement age in Israel, the answer is yes. That if you've been working under the new Israeli retirement system, which has been around for quite a while now, and you contribute under those conditions into retirement for 30 years, sometimes for 40 years, then you'll have usually more than what you'll need in order to be able to retire comfortably. In fact, when you have a look at kind of the global recommended percentage contribution to retirement, it's about 15% of your income. At 15%, you should be able to have a pretty comfortable retirement. And here we're at 20%. So obviously there are exceptions, people that don't necessarily work consistently and people that take a lot of time to build up their careers and all sorts of other things. But for the average person, when you're thinking about your own children who you can educate from a young age and you can help ensure that as long as they follow the regular system here, they're going to be putting away a lot of money for retirement, I think you can be pretty comfortable that they're not going to need a huge amount of help once they get to retirement age. And so then the question becomes, what do they need help with? And I can say, certainly for myself personally, I have 3 young kids, 7 and under, but also very, very consistently across the people that I work with. People want to save to be able to pay for bar mitzvahs, to be able to help their kids pay for weddings, and potentially to help their kids put together a down payment for an apartment and other related costs around getting through your 20s. And then the question becomes, what is the best way to be able to put money aside for those purposes? And can the Trump accounts at all? So that's kind of the framework with which I start.
I hear.
Yeah, wow, that's really interesting. I mean, that's fascinating because it's so easy to, like for us, I guess, Yaakov, to look at the tax side and forget about the goals. And now that Nadav is speaking, I'm like, right, like I want to help my kids, buy a house. Like I want to help them in in their weddings. And now to put $5,000 for their retirement sounds, not so attractive.
Right.
In fact, I would either say, just to round that off, that the rates of the automatic retirement savings rates are so high in Israel that I think there might be a need as the years go on for lobbying efforts to have the option of reducing them somewhat, to enable families to have a little bit more money available for the things that they need during the younger years. And there is a negative side of putting away too much money for retirement, reducing the liquidity and the flexibility around money and struggling through, 30s and 40s, but then having a very comfortable time and maybe excess money when you get to 60, 70, 80.
Right. I think if we look at the US, it's a little bit different, right? The US economy is something where IRAs, 401ks, they have a plethora of investment tools that you could use, but they aren't, or retirement tools, but they aren't mandated in any way. It could be that your employer might have a 401k contribution that you're able you're able to benefit from. But otherwise, there's this new culture that is kind of breaking out of entrepreneurs, of, you know, of people having their own businesses and the like, in which case very often they won't elect to put money into retirement savings. In Israel, even if you're Atzma'i, the rule is that you have to, by law, put some money away into pensions and the
Nowhere
like.
near enough, but something.
Right.
Yeah.
But there's something there that you have to, where in the US, it's like entirely voluntary. The only thing that you have to pay into that is kind of a retirement structure is Social Security. And I think nowadays everyone is kind of more nervous that, hey, the kids who are if our kids have to put money into Social Security, what is the likelihood and the chance that there will be anything left by the time that they retire? And so for people in the US, this might be a phenomenal tool to kind of do that. But in Israel, where you are already mandated to put money away for pension years and the like, it might make more sense to put. And that's why Nadav, you mentioned earlier, why is this more beneficial than like a 529 or other kind of plan? And that might be something that is, um, people are always looking to kind of put money away for their kids more when they have it. What other investment tools or retirement tools can I help my kids with? But it is more 529 could help with university, like you mentioned. There's other things that you could do. I will say that IRAs by default do have some exceptions. So you can do it for like a first time home purchase. You can take out $10,000.
Nice.
How much $10,000 will help you in a home purchase in
In
Israel these
Israel,
days?
in America.
Right? Exactly. It's not gonna be too much, and that $10,000 when you take it out, it just means that it isn't subject to that 10% early withdrawal penalty. It's still taxable to you. So you're still paying, a nice amount of tax on it. Okay, so
Are there any other exit strategies from IRAs or the Trump accounts, or it's locked until retirement?
the Trump account in the first 18 years, very much locked, meaning there is not anything you can do with it, right? After that, when it's in an IRA, so I will say that there are tuition fees or something that you could potentially take it out for. Again, it will be taxable when you take it out for that. But
Mhm.
there isn't anything like there's no like bar mitzvah clause, like there's no wedding clause,
Maybe
that
that's the next step. We'll add that in to the Trump
yeah,
account.
exactly,
Yeah.
exactly. If you have to pay for a wedding, there's nothing there that says you're allowed to take it out. I will say during times of crisis, like during COVID and the like, the government does become more lax with the rules and they let you take money out when necessary for big expenses during crisis years. But that again is not a given. So if you are planning, if your goal is to help your kids with their own kids and the like before their retirement age, it is something that is lacking there.
Yeah. And
Mhm.
so I think, if you have a goal around generational wealth transfer and there is excess money and you're trying to build a lifetime plan around how to pass that money down to kids, maybe both of you have some tax comments on that, then I can potentially see space for a Trump account within somebody's financial plan. Do either of you have thoughts on that, on the tax efficiency of using Trump accounts for that purpose?
Well, I think the nice thing here is the tax-free growth, right? That is definitely, and there are people who have more money than they know what to do with right now. And so they are like, let me maximize the retirement benefits I can do. And so putting money into and like we said earlier, there are a lot of people who will hire their kids in order to be able to fund their IRAs and the like for those kids. So there isn't necessarily it isn't necessarily a bad idea for those types of people who are trying to do that anyway. Put it in if those people who have enough money right now that they thankfully have more than what they need to live on, then they're able to have this additional benefit to put money away for their kids and the like to kind of grow and help them.
Right.
Alternative to that, I mean, Shaked can tell you all different kinds of stories of people opening trusts for the benefit of their kids and all of the different headaches in terms of taxes and the like. And so if you're trying to use some kind of, trust structure but usually if you are, you're putting away lots more money than $5,000 a year for the benefit of those kids.
Yeah.
Right. Right. Yeah. And also, there are a lot of tools or retirement vehicles that make a mismatch and an accident with the US tax laws, right? So, Keren Ishtalmut, for example, in Israel, it will be tax free. You take it out after 6 years, it's not taxable, but in the US, you will pay tax. And, this account, it has its limitations, but it does match and you won't pay double tax.
Right.
So
I
if
mean,
we,
yeah, if you have the option between this and like an Israeli investment account for your US kids, you know, I don't know that this would end up being so much worse than that.
right. And so I'd be very interested in hearing kind of your thoughts on the two alternatives that I usually talk with clients about. Let's say, for example, US citizen clients. Number one, a US taxable brokerage account. You know, a lot of people do as much as they can to put money away tax free. But at the end of the day, I think that looking at goals and looking at access to the money, liquidity, is often more important than the taxes to make sure that you can achieve the goals that you have for your kids. And there's nothing wrong with opening up a brokerage account, depositing money in, investing in some kind of low cost index fund, which maybe we'll speak a little bit more about because the Trump accounts are very unique in the restrictions that they place on the accounts themselves. And in that way, you can completely avoid any PFIC issues from the US tax perspective. And the tax treaty is able to deal with the proceeds of the account to make sure that you're not paying any double taxation. So I think that that can be a very good option. The other thing that I encourage clients to often consider is to allocate their employee Karen Ishtalmut for the purpose of their children. So it's an account that is not in the child's name, it's in your own name, it's paid in by your employer. The major benefit from the Israeli perspective is that with the Karen Ishtalmut, you have tax-free growth, assuming that the deposits were up to the tax cap. And whenever we have tax-free growth, the longer we can defer the payment of that tax, the longer we can keep the money in the account, the more benefit we have. So although there are some financial professionals that recommend never ever take money out of Keren Ishtalmut, I rather like to say Keren Ishtalmut should be the last vehicle that you take money out of. And so if you're somebody that has young children, then within your financial plan, allocating your Keren Ishtalmut to be able to help your children with weddings and with the down payment for a house can be very effective because number one, it gives it a purpose that is 20 years down the road. And number two, it often will be able to grow in that time, given the compounding effects of 20 or 30 years, to be a significant sum. A single Keren Ishtalmut can grow to million shekels, even in real terms, even after we take into account inflation over that kind of time horizon. Obviously, there are the U.S. tax issues to also consider. I don't know, Yaakov, if you want to add
Yeah,
to
no,
that. Often people can
sure.
have tax credits, foreign tax credits that are rolled over to be able to account for some of those
Yeah.
US tax issues.
Very often, I'm a big fan of Kanish Talmud because it does grow tax free for U.S. purposes. Again, assuming it's coming from your employer, and each different U.S. accountant will tell you something differently about it. But I think there's a good basis to say that it is treated that it is exempt as it's growing, and then it's only taxable when you take it out. Is tax free in Israel, like Shek had mentioned earlier, which creates more of a problem with U.S. taxes. But you can, if you file correctly and plan for it, build up those tax credits and the like to then be able to offset the tax on Kanishdam with distributions in the future. The only note I would add is with the index fund, right? If you are just investing in a U.S. index fund portfolio account instead, so that will be subject to tax between Israel and the U.S., right, as it's growing. And so I often have this similar conversation with people who have RSUs and stock options and the like. And I'm like, look, sell it, right? You'll pay the negative tax aspects between US and Israel right now, but then you can reinvest those funds into the same stocks if that's what you believe in, or diversify, whatever you want to do with it. And that's always still a struggle for them because they're like, look, but then I only have the post-tax money to invest. Right. And so here, when we are talking about kids who are so young, that growth and the taxes that you pay on an annual basis over 60 years as it's growing add up significantly to that time horizon of if I put the money away and then I just forget about the account, for 60 years. Like you could put, again, a one-time payment of $5,000 that you have spare from a grandparent or something like that, put it into this fund, totally forget about it for 60 years, right? And then all of a sudden it's this huge, nice lump sum amount that you can either withdraw or take out periodically and have your pension with, as opposed to it being much less than that because of the taxes that you're paying on an annual basis.
Yeah.
Karen Ishtamut kind of gives that to you though still, right? The Karen Ishtamut would still grow tax-free. Yeah, it's definitely an interesting perspective to look at.
And so maybe around that one now before maybe we talk a little about the investment allocation of the Trump accounts. I would encourage anybody listening who's considering where they should be putting money aside for to first consider their goals. What are you looking to achieve? Because certainly for me personally, I have no interest in putting money aside for my kids' retirement. I don't think they'll need assistance at that point, but they will need significant assistance with something like buying a house, buying some kind of property in Israel, which can have a real impact on their life over a number of decades.
Right. I think
So let's say for sorry, Yaakov.
no.
So for families that they're high income families and they want they have enough money to put to fund these accounts. What are still the advantages of these accounts? I heard there are like restrictions on the investments themselves inside the account.
Yeah, exactly. There are very significant restrictions on what the money can be invested in. At the moment, it seems that the money in the accounts can be invested only in index funds. In other words, if you want to take the money and invest it in individual stocks, you say, I think Nvidia is going to grow another 30 times by the time my child retires. That's not an option. And secondly, the index funds themselves need to be US index funds, not just that they're registered in the US, but that the assets are at least largely US assets, which is an interesting one. Because when we think about for diversification and risk management purposes, investing in index funds is incredible. It removes a lot of fear and bias from the investing process, a lot of the urge to trade and to try to time the market. But at the same time, investing in one specific market like the US has its risks. If we take the S&P 500, for example, which is the most famous index, if you're investing in the S&P 500, you're investing in 500 of the largest companies in America and 500 of the largest companies in the world. Those are all American companies, and you've got significant exposure to the American economy. While those companies sell all around the world, and so you do get some global diversification, if there are between now and 60 years from now, if there are any major changes in the macroeconomic or the geopolitical structure of the world, particularly when it comes to America or the US dollar, then you may see significant drops in the value of the money that is invested there. And so when we teach investing in index funds, we take into account the fact that over the last few decades, the US market has done certainly much better than the rest of the world. But we also try to look into the future and anticipate, will this continue forever? And is there any value in further diversification beyond just US indices?
Can it be changed after it switches from the Trump account to a regular IRA account?
So that's a good point. I believe it can, certainly based on what Yaakov was saying before, that then the IRA general options open up to you. So that does limit the risk.
Yeah.
Because only for a period of time you'd be invested in specifically US exposed assets, and you can consider further diversification beyond that.
Right. I think the goal here is that they wanted it to be limited to US index funds. This way, again, it's reinvesting the money into the US economy, right? And at the same time, the other aspect of it is that they wanted it to be very, very low cost, because we've seen some estate plans that people set up with international trusts and these trustees that are sitting all over the world. And you look at the amount of income that the trust is earning for those kids and for the next generation, and it is equal to or less than the amount of the trustee fees that could be there. And so you kind of look at it and you're just
Crazy.
like, this wasn't set up this way on purpose originally. And so this is it's supposed to be limited in terms of what you can invest in, but also then the fees are very minimal in terms of what you are charged. So this way it can grow for those kids. But yeah, absolutely. I mean, we saw today, Nadav, to your point, well, not today, this year, right? 2025, if you look at it, people who were invested in their Israeli bank accounts and the like in US S&P 500 funds. So the S&P 500 increased this year, but the dollar to the shekel dropped. So everyone was, I think you had a lot of people turning to you and being like, hey, it looks like I'm losing money on these funds, right? While
Yeah,
everyone is going to
this
the
year
US.
people, saw a 3% return in their account, but they're expecting a 20% return.
Yeah,
And what's going on there. I will say that for the long term, currency movement and currency risk isn't as significant as it is in the shorter term. And in fact, the phenomenon that we saw this year is quite a common one when it comes to the relationship between the US Israeli exchange rate and the US stock market, which actually is somewhat positive. The fact that often when there is a crash of the market, there's an improvement in the US dollar. And so there's somewhat of a cushioning effect
interesting.
when you have a look at the relationship. But it does mean that in a year where the market goes up significantly, you don't necessarily see as much of that when you look at your performance in shekels.
Okay, cool. So anything else, Nadav, that we want to add before we sign off here?
No, I think that it's a really interesting development. It adds another another tool in the toolbox to be able to think about how to allocate money for your children, depending on what your goals are, and creates more work for those people who are trying to provide guidance and provide financial planning and to provide tax advice so that we can ultimately help people understand how to best plan for their future and for their children's future.
Fantastic. It's fantastic. And it is, as US citizens living in Israel, I think it's always a struggle to know what to invest in, what not to invest in, all of the different US Israeli complications that come up with the investments. That scary evil word, PFIC, passive foreign words, I guess, passive foreign investment companies. Right. So thank you. Thank you for the guidance there from both of you. Absolutely. If you are interested in terms of financial advisory, what to put your money into, how to build a financial plan and the like. Nadav, what's the best way that people can reach out to you?
You can head to our website at bluewhitefinance.com and either reach out to us there or take a look at all the free guides that we have on all of these topics that we're spoken about today, plus many others.
Amazing. And Shaked, by you, if people wanted to get in touch in terms of they're coming or they're in Israel, all of a sudden they have to deal with everything within the first 10 years of Aliyah, post 10 years of Aliyah. They're not exactly sure how it's going to come up. And now 2026 onwards, anyone that's coming is going to have to file from the very first year, even if there's that exclusion, right? What's the best way to get in touch?
Right. Yeah, a lot of changes for Olim Chadashim, and yeah, I'd be happy to help with with everything that you mentioned and every Trump product that may come. Best way to reach me will probably be my email. If there is like a show notes, you can add
Yeah.
it there.
Perfect.
Yeah.
We'll make sure to add it in the show notes. And you can listen to the rest of the episodes that we have here on Spotify, anywhere where you can get your podcasts, YouTube, and the like. And thank you again, guys. This is phenomenal. If there's any last word that you would say with these Trump accounts or with anything else, what would it be?
If your child was born in 25 to 28, get those $1,000.
Free money.
Exactly. Okay, very cool. Awesome, guys. Thank you so much.
Thanks for having us on.
All right. Bye. Thank you, Yaakov. Thank you, Nadav.